Good evening. After those first two presentations, I don't know if it's a good thing to have in your bio that you worked for two of those institutions that came out of the New Deal and those housing issues. I worked for both. As you noted, I worked for both the Department of Housing and Urban Development and Fannie Mae. So I have some experience with some of those numbers and programs that get shown there. I'm going to try and cover three things here, if I figure out how I'm going to do this. I'm going to talk a little bit about some random facts, maybe not quite so random, about the Iowa housing situation where we find ourselves, a little bit about the Iowa Finance Authority, and then go to some of the activity that we're currently engaged in, both at IFA and generally dealing with both the recovery from the disasters of 2008 and our role in working with some federal programs for the economic recovery. We do periodically at IFA, we do studies about the housing situation in Iowa, and you can find these on our website. The University of Iowa has conducted 3 housing needs studies for us, 2005, 7, and 9. There's a lot of very interesting information in those studies. We also did the Iowa State did a study for us on housing needs and housing status just this year, and that study is also out there. And we do spend some time trying to figure out, what the housing needs are in Iowa and what kind of response, what kind of programs we ought to have as a result. Some of these findings won't be any surprise to you. We've had 36,000 new international residents in Iowa in this decade. We still are a very Caucasian, non-minority state. We have seen growth in minorities, Black, Asian, and Latino, and it's interesting to be aware of where that growth is. The Latino group is in what we call the micropolitan, some of those mid-sized cities that are below 50,000 in population. We are more of a home ownership state than the national average. In fact, we are depending on the year, 4th or 5th highest home ownership rate in the country. 72% is in metropolitan, micropolitan counties, 28% located in rural counties. Across Iowa, growth in housing unit outpaces growth in population. That's my trick fact for the presentation, and think on that for a minute as we talk about housing needs. Because we have substantial and significant housing needs, yet we do have more units than population in terms of growth. The discussion about why that is a very interesting discussion and says a lot about not only housing policy but economic activity in the state. We have vacant units, and we have units that are staying vacant for a very long time. As you might expect, metropolitan areas outperform rural areas in terms of residential assessed property values, wages, and salaries. Nothing really surprising there, but the documentation is a little tough to take if you if your home is in rural Iowa. Some of this material, again, should not be surprising to you, but it comes from the National Low-Income Housing Coalition. To be able to afford a 2-bedroom apartment in Iowa that would rent On average, for 629, you need an hourly wage of $12.10. That's up 26% from the year 2000. Would mean you'd have to have an annual income of $25,000, and if you were a minimum wage earner, you'd have to have 1.7 jobs. So you're going to be working 70 hours a week. Unfortunately, that isn't the pattern here in Iowa. We have 300,000 renters, 28% of the population, and their wage is around $11. We said they needed 12, they're earning 11. So 1.7 isn't going to get us there. And the only rent that's affordable for them is $572. Again, that gives us, that sort of documents and demonstrates the gap we have. The Iowa Finance Authority was created in 1975. And this was at a time when the federal government sort of passed some legislation that allowed states to issue tax-exempt bonds, and in many states, not all, but in many states, the response to that new authority was to create instrumentalities like the Finance Authority. One of the reasons for that is many states, like Iowa, have prohibitions in their constitutions against the state backing debt. And to be able to effectively use this federal authority, you had to have a quasi-governmental authority that could issue debt, but it wasn't explicitly backed by the full faith and credit of the state. And you'll see we are a self-funded agency. Our operating budget is self-funded. We live off of, I won't say profits, but we live off income we generate through the administration of our programs. By and large, although we have a couple of exceptions to that, we don't receive state tax dollars or state appropriations for our operational expenses. We fund those ourselves. We're there to finance, administer, and advance and preserve affordable housing and to promote community and economic development for Iowans. And it's a big job that we share with a lot of other agencies. We serve the homeless populations, moderate income, new homeowners and existing homeowners, nonprofit organizations, and private developers of affordable housing. A lot of that housing goes to people with disabilities and other special needs. Now we do that by administering some of the programs that have been referenced in the earlier presentations. We administer most of the federal dollars that comes through the state for services to homeless people. Our two biggest programs that we administer is the first-time homebuyer program, where we can issue federally tax-exempt bonds and use the bond proceeds to fund mortgages for first-time homebuyers. In a normal financial market, or what we used to consider a normal financial market, that meant we could offer mortgages to first-time homebuyer, mortgage rates to first-time homebuyers that were below market. During the financial uproar of the last couple of years, that hasn't always been the case, and our rates have sometimes gotten out of line with the market as we have depended on tax-exempt bond funding, and the federal government, through some of the measures you've heard about, has intervened in the housing market. But we are back to more close to what we considered normal markets. We look at market rates in the state right now being something over 5%. We had been at 4 ourselves for our first-time homebuyer loans at 4 3/4. We just raised those rates to 5% today. The other big program we operate is also referenced in the previous presentations, is the low-income housing tax credit program. We are the entity in the state that gets to allocate those federal credits. The federal government, through actually the Treasury, of all things, sets the guidelines for how we can allocate those low-income housing tax credits. And they have become, if not the only, certainly the biggest tool for financing affordable housing in the country, not just in Iowa. And I'll say a little bit more about that in a minute. We also are the agency that administers the Local Housing Trust Fund program. That is a relatively new program that the legislature started a handful of years ago and represents a state initiative in both directing some state dollars at housing needs and I think quite, if not uniquely, but quite appropriately structuring that assistance in such a way that decisions on how that money is used are handled locally. It is a program that we hope to see continue to grow and continue to justify additional funding from the state. In the previous presentation, you heard about the HOME program, one of the federal government's funding mechanisms for affordable housing. That program has been at the Department of Economic Development in this state for some very interesting historical reasons, but it is now moving from the Department of Economic Development over to the Iowa Finance Authority. So we try and serve a very broad spectrum of housing needs through these and some other programs. The government, is, as you've heard in the previous presentations, has been involved in housing for a long time. It has not been a major focus of state government. As I said, the Local Housing Trust Fund represented a major step on the part of state government to provide some state resources to affordable housing. What the state, by and large, has been doing is been administering many of these federal resources that the federal government has made available over the course of the last couple of decades. Things started to change a bit and have changed since the disasters of 2008 and the recession we've been in. Flooding has caused a lot of dislocation. As you heard, the recession has caused spikes in foreclosures. Tightening of credit has made it harder for people to qualify for a mortgage loan, and IFA certainly had its own impact of that housing crisis as we try and go into the capital markets and raise money for the housing programs that we operate. But as a result of the disasters of 2008, we got, it's one of those federal good news, bad news. Good news is we were getting a huge increase in the amount of low-income housing tax credits that we could allocate. We normally get about $60 million a year. And as a result of the disasters of 2008, we got an increase, we got an additional $200 million each of 3 years, 2008, 2009, and 2010. That was the good news. There are a couple of bad newses coming along with it. The first bad news was the 2008 allocation was made in September of 2008, and the federal government, in their wisdom, said, use them or lose them. So at IFA, we got busy and put them to use. A number of states simply turned those credits back in and told the federal government they didn't have enough time to put them to use. But as a result of the credits, the additional credits we were allocated from the disaster, we've financed an additional 2,700 units of rental housing for low-income people across the state. In response to the recession, the federal government passed a number of economic stimulus provisions, and we operate a number of those provisions ourselves. The homeless programs that we administer received an additional, actually across the state it was about $17 million of additional funding. The larger cities got a direct allocation. We were given about $11 million to allocate for homeless prevention and rapid rehousing programs. Really is a significant increase in resources available for those services, and to some extent a change in direction of the federal government, but this was intended to be a 3-year program. The way things look now, we will spend that $11 million in around 2 years. So it gives you some idea of the need we're seeing out there. Another element of the bad news about the additional low-income housing tax credits we received is that the pricing, the value of those tax credits because of the financial crisis plummeted. Developers in Iowa who are used to being able to get maybe 85 cents for those credits when they were allocated to their project were told that maybe they were worth 60 or 65 cents. So their value to help support a project really was diminished. To try and offset that, because it was a national problem, we had the Tax Credit Assistance Program and the Section 1602 program, about $90 million we were able to pair with that $600 million of low-income credits to get those projects done. In response to the foreclosure, there is an additional federal program that funds foreclosure prevention counseling. We've applied for and received $1.7 million for that program, and working with the Attorney General and the State Attorney General and Iowa Mediation Services, as well as local housing counselors, we put together a nice system. We're very thankful for the $1.7 million. Unfortunately, again, because of the need, we're spending it faster than the federal government making it available, and that program is in danger of running out of money. Because of the disasters also, the state did allocate significant amounts of state dollars towards disaster recovery, and a noticeable amount of those resources went towards housing. One of the first things we did in the disaster recovery effort is initiate what many people, depending on where they're at in the process, say fondly or with some anger, Jumpstart, to help people repair flood-damaged homes or to help them with a down payment to replace a home that could not be repaired. We also, in I think a first in the nation move, we also added to that program something we called interim mortgage assistance, which we help people make their mortgage payments while they're waiting for a flood buyout on a flood-damaged home. The third phase of this program, we received two direct state one transfer of some state funding, one direct appropriation from the state, and then the third phase of that program was funded through the iJobs program, which I'll talk about here in just a second. Many of the elements we put together in the state-funded program were incorporated into the federal disaster response, incorporated into the block grant funds that Congress appropriated to us as part of their disaster recovery funding. And as we sit here today, about $200 million of the almost $800 million that's been allocated to Iowa for disaster recovery is going back into housing programs, either single-family repair or multifamily repair or single or multifamily new construction. There's another $250 million of that funding that's been allocated towards buying out flood-damaged property or properties in the floodplain, but I have a hard time counting that as housing money because we're again tearing down homes, not creating or preserving units. The iJobs program you've heard a lot about had a number of housing initiatives in it. IFA was allocated $20 million for affordable housing projects. We are in the process of expending those dollars, and they have just about all been awarded. Iowa City has received some awards of that funding and currently has a program going on to repair and reuse some near downtown housing that's, I think, a very interesting and innovative partnership that I'm quite happy we were able to fund. We received some funding for shelters in this state, and it is very unusual in the funding matrix we have to be able to provide capital dollars for homeless shelters, domestic violence shelters, and other facilities like that. That $10 million was a very welcome resource for those programs. And I mentioned Jumpstart 3 that provided some money for the third phase of the Jumpstart repair and replacement housing program. In the state response, well, some of the state things we do, as I said, the primary tool the state has chosen to fund is the Local Housing Trust Fund. That was set up several years ago, and at the time it was created, there were not very many local housing trust funds. So that program really has two buckets in it, if you will. One bucket says of the money allocated to local housing trust funds, at least 60% of that funding must flow to certified local housing trust funds. And IFA is the agency that certifies that those trust funds have been established, and then we pass money through to them. The other side of that was what was called the project-based funding, and so money that wasn't allocated to local housing trust funds was reserved for, in the beginning, reserved for parts of the state that didn't have a trust fund and still wanted to apply for housing projects. And we would allocate that money to project-based initiatives on an application-by-an-application basis. We have been very happy with the growth in the number of local housing trust funds, and we now cover much more of the state with trust funds. So the legislature has changed the legislation to where project-based funding can be used in areas that are served by local housing trust funds. The bad news about the growth in local housing trust funds is, in the number of local housing trust funds, is it puts a lot of pressure on the funding for local housing trust funds to keep pace. And that is funded by allocations from the RIF fund and the real estate transfer tax. We have a lot of work left to do in housing in Iowa. It's one of those ongoing discussions, and some of the issues you saw in some of the some of the material from the previous presentations about the needs at low and extremely low income people, and that is mirrored here in Iowa. If you look at the housing needs studies that the University of Iowa has done over the years, clearly and not surprisingly, very low income people have the biggest needs. And even with the welcome increase in low income housing tax credit projects that we've been able to get, that still is an area of probably our greatest need. As I mentioned, we've had growth in local housing trust funds. I really hope that we can continue to increase that funding and increase the capabilities and local fundraising, resource gathering capabilities of those trust funds. They really are set up to receive some state funding, but more importantly, leverage that funding with local resources and use those resources to meet local housing needs, not have the array of needs they're funding dictated by the federal government or the state government. We have our share of issues with workforce housing. The federal government in its resources has long had some rigid guidelines about what affordable housing is. In the low-income housing tax credit world, to rent an apartment that's been financed by a low-income housing tax credit, you have to be at or below 60% of the area median income. To be considered eligible for home or block grant funding, when that funding is used in housing areas, you have to be at or below 80% area median income. That's a household income definition. So if you have two wage earners in the household, it doesn't take very much to get above those guidelines. And then you're not eligible for a lot of these housing programs. So where we have two-income families, in Iowa is one of the highest, if not the highest, percentage of households with two incomes. We see working families, in a lot of cases, ineligible for existing assistance programs. We also see some places where we spend a lot of money to draw new jobs into an area, only to find out that there isn't sufficient housing to be available in that area that really makes that employer feel comfortable that they can maintain that workforce. So workforce housing, I think, is going to be a growing issue for us. And then just this year, the legislature raised the issue of smart planning. And we're going to be doing more in that issue and trying to coordinate activity, not only economic development activity as we try and draw jobs into an area, but transportation issues, water quality issues, as we look at the overall planning needs of a local area. We had a rude awakening here recently when many employers whose workforce was spread out over a large area in many of our smaller communities. When the price of gas rose, all of a sudden that job was not as sustainable for that family as it had been before. You saw the numbers on transportation and housing needs, and they work in reverse too. If you're commuting 60 or 80 miles a day and the price of gasoline goes from $1.50 to $3.80, all of a sudden your available discretionary income has changed dramatically. So that smart planning initiatives that the legislature has enacted this year I think will become increasingly central to our discussion about housing and economic development in communities.